Hi, this is Dana Stalder with Matrix Partners. I'm here today with Morris of Nyca Partners, and this is part of our ongoing series on fintech. And today we're talking about innovation in the payments industry. So one of the areas where we're seeing a lot of innovation, particularly in the last 5-10 years, is around credit and lending, right? One of the largest profit centers of the global financial service industry. What is your perspective on that category? And where do you think where have we been and where are we going, and where is there room for more innovation here?
So we're big believers in this too, and I put everything in this historical context, so maybe that's good or bad, but I think it helps explain where we are. Yeah. So, to me, the multi-decade framework is information costs have declined, and information costs allow lending decisions to be made by capital markets investors versus saying I need to have a bank or other intermediary to provide that credit decisioning. Yeah. And the way I frame it is when I started on Wall Street in 1980, there were about 100 companies in the whole world that had access to the bond market. So most credit formation was in banks and insurance companies. In that decade of the 80s, you had Rule 415, you had Bloomberg terminals come out, you had all these other means of information dissemination and rapid decisions around credit formation, so that by the end of the decade, all investment grade companies had access to the bond market. In the 90s, really all non-investment grade companies that were decent size had access to the capital markets. Again, same thing. I could make sophisticated credit decisions. I didn't need to be in Detroit to understand how to evaluate an auto parts company. I could sit in Tokyo and make that decision with the information I had. Then in the 2000s, the entire bank loan market shifted to capital markets. So even though it's called bank loans, syndicated bank loans are 100% capital markets investors.
Yeah.
So so what do I think is going to happen now? What is the framework for this? I would say consumer loans or small business loans or realty loans, some of which have already had access to the capital market, that lends itself, some of those lend themselves very well to direct capital market investment. And so when I look at LendingClub, as you said, I'm a director there, and I thought that it was great technology, and what they were doing is they were focusing on what I would call investment grade consumer loans. So high, people that's quite predictable cash flows. Yeah. And certain cash flows are riskier than others.
Oh, but leveraging FICO scores and understood
bureau data and other stuff, and if you have access to long data sets, and if you have bureau data, if I'm prepared to offer you credit and I'm authorized to pull a bureau, I basically get all the information on anything you've ever borrowed in your whole life. Yeah. So once I have that, and again, if I'm focusing on higher FICO, and FICO or any of the bureau scores do a good job of predicting the past. So if the past is the same as the future, they're excellent. They definitely rank credit. If the future is going to be different from the past, they're not so good at that. So that's where some of this alternative data can maybe give you more insights than the bureau scores have.
What's the driver of so much innovation, right? You've got On Deck, Cabbage, even Square now moving into kind of the merchant small business lending. You've got Avant Credit, Zest Finance, and the likes on the consumer credit side. You've got SoFi and student lending. You've got, in most of these, certainly the banks have been bypassed as sources of capital, right? And it is either private equity or hedge funds and private equity funds or capital markets that are now underwriting these loans. What happened here over the last 5 years?
Let's go back to my multi-decade thing. Information costs decline. If an investor is able to confidently predict those cash flows, if they can do that with confidence, and two other criteria, there's enough liquidity, it's a big enough space that they will do the homework. It's a big issue, because if they're small, if you're an institutional investor, you want to put tens or even hundreds of millions of dollars to work, you're not going to do it if the entire space has 400 million of available credit lines. So you need billions. But once you do that, from a efficiency standpoint, it's very efficient because the originator doesn't need any capital. I think the best of them, like LendingClub, did a very good job of creating a very seamless process, both from the borrower's perspective and the investor's perspective. And the other key variable is the risk-adjusted returns to that investor were very attractive compared to alternatives. So if we take LendingClub, if you say it's investment-grade consumer credit, so that's high FICO, right? The average is 720 or something, and those credits, if you bought a comparable securitization with the exact same type of credit, identical, the returns you were getting from a LendingClub investment were many hundred basis points higher than you would get from a similar credit tranche of a securitization. Identical collateral, much higher return. So the risk-adjusted return.
And why is that? So why are the likes of LendingClub able to create a package of loans that actually yield more than something I could get through?
Well, if you go do the securitization, when you do a securitization, those loans have been originated by a big bank, and that big bank is keeping a excess servicing layer of for themselves. So the investor is getting a lot less.
So a bunch of intermediaries.
Take
been pushed out, and
I think that the other thing LendingClub did is they have a very efficient origination process. But then once you get the loan, you only can pay and get paid through ACH. There is no statement. The statement is electronic statement. There is no, so your servicing costs are literally zero unless there's a collection, and then those collection costs are passed on to the investor. So it's highly efficient. Not at all. If you think about, at a large bank, credit card bank, they were created with paper-based statementing and everything. So they're trying to shift people away from that, but it's
a process.
It's a process.
Do you think this is where are we in the innovation cycle?
So I go back. So we've invested. So our criteria is then has to be a large credit area. So again, we think that the real successful marketplaces will be where there's quite a bit of credit. You have to also be able to demonstrate that you can predict cash flows accurately. So some companies, I think, have something interesting or a source of data or something that's proprietary and lends you to that. Others, in my opinion, don't. And saying, well, we've got 4 months of data or even a year of data is kind of irrelevant because you haven't tested it through the cycle. And credit is credit's very. I've been doing credit for 30 years, so I will tell you that. Credit, first of all, attracts bad people. Some people do not pay you back. And you also there's selection bias in this, so you often attract people that are unlikely to pay you back. There's lots of fraud, and the bigger you get, there's more and more fraud. So there's a lot. I actually apply high standards to investments that we would make. However, I do believe this will be a multi-$100 billion marketplace. And in the same way, everything else I talked about, bank loans and non-investment grade, became a multi-$100 billion marketplace. But liquidity, high risk adjusted returns, good infrastructure, and proprietary access to data, those are among the characteristics that we look for. Yes. There's some very innovative companies who are also saying, well, if it's going to be a $100 billion marketplace, what else do you need? And the institutions need you need order management systems, you need custody, you need secondary market capability, you need performance benchmarking. So all these other characteristics that investors want that you don't get from your existing tools. So we've invested in Orchard, another company that does that, and
what does Orchard do?
Orchard basically is providing that institutional platform for the institutions to make investments across various platforms.
So
you're an institution. You're sitting there and you say, "Well, here's my criteria I want," and then it will go and look for those loans.
I could invest in Prosper. I could invest in LendingClub. I could invest in
private stuff. It could be you could have some other company that is doing leasing, equipment leasing that is not necessarily a marketplace, but they have loans. They format this in a standard, consistent way. Standards, by the way, are a key part of success. So standardization of terms, of fields, basically, ability to take unstructured data and structure it is key.
What's your take on? I've seen many new entrants in the lending space, and some are pursuing the peer-to-peer model, where they're trying to be a marketplace. They don't hold the loan on their balance sheet, a la LendingClub, but I've seen others who just it's complicated for a startup to build a peer-to-peer. And they find somebody who will give them the credit to actually loan and build a business. What's your take on if you're entering the lending business, going the peer-to-peer approach versus the...
I think it comes down to what I said before about liquidity. So no one's going to do the work if first of all, if you can't demonstrate that you can accurately predict cash flows. So if you don't have the data, you basically need to experiment with someone else's money. You can trust your own money. It's got to be on your balance sheet with all the risks and rewards for a while.
So does that mean it's easier to migrate to a peer-to-peer model after you kind of get some cohorts and collection history and understand what the economics are going to be?
I would say we'll end up with a hybrid in many cases. I think that's where it will likely end up. You also need, one of the problems with a balance sheet driven model, pure balance sheet, is there's no operating leverage on capital, right? If you're going to be extending credit, you need a certain amount of capital for every extension of credit. So if you're going to originate $1 billion worth of loans, consumer loans, probably need 250 million capital. Yeah. And that's a lot of capital. And if you then do another billion, you need another 250 million capital. So it doesn't go down as you get bigger. Yeah. And then another rule we have is, okay, if it's a financing business, balance sheet intermediary, you have to have the treasury plan and capital structure to finance yourself through the teeth of a crisis. So we're back in Europe during the Greece eruptions, or we're in the United States in 2008 when you had the structured commercial paper business, industry went from 1.6 trillion to maybe 400 billion in a couple of months. Yeah. That brought a lot of companies to bankruptcy.
Yes, it did.
And all your committed lines aren't really committed. So all these things that you thought you could rely upon aren't there. So you need. I tell this to companies, and this is my being a wise guy about this, but I would say, okay, what is 1962, 66, 1973, 74, 1979, 1981, 1984, 1987, 91, 94, 98, 2001, 2007, 2008, 2009. What do all those have in common? Those are periods when the capital markets were closed. There was no ability to access the markets. And so therefore you need to have the liquidity and the capital to withstand that. Yeah. And that's true no matter what structure you get into. And the larger you get, the problem actually gets more complicated.
And the more exposed you are to these cycles, absolutely.
So that's in my opinion. There's a lot to learn about all this, and there's a lot of developments and infrastructure needs and evaluation tools that the investors will be requiring. So there's a lot to do in this whole area, and there's lots of room for innovation. I think,
as it relates to opportunities for innovation around credit and lending, how do you think about the opportunities in the United States versus outside the U.S., and where is there a greater opportunity to innovate and build new businesses?
Well, I'd say the regulatory environment in every country is different. So you can analogize. There's some similarities, but there's just as many differences. And as we said, in payments or credit, details matter. So all those little details would affect things. So there's some real advantages of Europe. The European Union allows passporting into all countries with a single license, but you need.
So I can get a license in the UK and then lend
but
in
you need a banking,
Switzerland.
You need a banking license. That's not a trivial thing to get. And then actually from the credit and privacy rules have advantages and disadvantages. So disparate impact, which is a very tricky thing in the United States, which says that I can lend money using a model, but if it turns out that my model gave disparate impact and tended to favor or deny credit to ethnic groups or by age or gender or something, then that's a liability you have just by assessing after the fact you have disparate impact. Yeah. So that's a really big, talking about data compliance, that's a really, really complicated thing in the U.S. You don't have that in Europe, so that makes it easier. Yeah. Privacy, though, in Germany is
Much stricter
tougher,
than the
much
US,
stricter.
yeah.
So,
Yeah.
so your ability to capture data, whether you have bureaus, if you go to emerging markets, there usually are not bureaus, or or the bureaus would be
Harder to get data.
much harder to get
Yeah.
data.
So it sounds like puts and takes.
Yes.
But certainly the opportunity does not only exist in the United States, and the details matter here, right?
Details
So-
matter, and you can leapfrog a lot of stuff. We have stupid things in the United States which date from the original electronification of a manual process in the 60s, and it's still kind of set up the same way. And luckily, if you go to India, they don't have that. they haven't created the electronic process yet.
Right.
So you can there's some things which actually might be easier to ignore existing systems.
Good.
Okay.
Thanks for your thoughts.
Thank you.